You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Mike Swanson from WallStreetWindow.com. Welcome to the show, Mike.
Oh, thanks for having me. It's great to talk with you.
After a very bumpy start to the new year, we've seen some little rallies. Are these decent rallies, or are they just sucking us into putting good money after bad?
I think they're just tricks and traps when it comes to the stock market. Now, we've got rallies and other stuff that I think is for real, but if you look at the U.S. stock market, we did have quite a tumble in January. It went straight down, basically, and went through actually the lows of last August and September earlier this month. Now we have bounced back up. The S&P 500, as we're speaking, is floating around 1920. But we did have a big rally for 3 days here. The Dow was up almost about 300 points 3 days in a row from the bottom. It got up above 1,000 points practically. It hit a low of 15,500 and went up to 16,511 earlier this morning. In a move, when it happens that quickly, you're going to see it stall out, even in a bull market, and go sideways for at least a couple days, usually a week or two, before it goes up again. Now, I think this is not a bull market and is definitely a bear market. We're below the 200-day moving averages for all these American indices, and most stocks are performing much worse even than the stock market is doing. They were, of course, doing that last year also. And to go back and understand how the market is trading, it's useful to look at similar historical cycles. And as far as the stock action goes, really the closest similarity to what we're seeing now is the 2000 to 2003 bear market. Now, we don't have internet stocks blowing up, but we've got biotech stocks that became a bubble over the past couple of years and are going lower. But more important is the actual action in the stock market. We're seeing the market basically, I think, in a big downtrend that can go on for a very long time, but during that time you can get sharp rallies that last a couple of days or even a week, and then they just peter out and things continue down. And that's what happened in that 2000 to 2003 bear market, particularly in the fall of 2000 from September to April. There was a big decline in which the market really traded out, kind of like we're seeing now. One of the things you can watch is the VIX, the volatility index, which measures the premium that people are paying for volatility in the options market. It gets above 30, and you can see these little lows come in and a rally starts, but then it'll get back down towards 20 and it peaks out. I can't predict, if this is going to go up a little bit more before we turn lower for good. My guess is we've got another week or two where the market can stay above 1900 on the S&P 500. It could possibly make another run up, to 1960 or 1980. I don't know if it will manage to do that, but it'll likely either way be okay for another 1 to 3 weeks, then start lower again. So I think really this move should be used to get out of some positions or even make bets against individual stocks. I think there's actually stocks blowing up almost every single day. Today it was a restaurant company that really got smashed, the Jack in the Box restaurant company. It seems like there's a company just about every single day, and not much excitement to the upside when it comes to individual stocks.
Any idea why Jack in the Box was picked on?
Oh, it just had a bad earnings report. And the thing is, with these stocks, the big problem isn't just, they have some bad news, but most stocks are frankly very overvalued. The cyclically adjusted PE for the S&P 500 reached a level last July, a height that it's only been at 3 previous times. That was in 2007, 1999, and 1929. And what the cyclically adjusted PE does, it takes the 10-year annualized PE average adjusted to inflation. A great example of this is the oil stocks. The price of oil didn't do anything in 2013 and 2014, but the oil stocks went up tremendously during those 2 years as people just got excited about the stock market and were buying things because they paid dividends. People were saying back then, if you can remember, that valuations didn't matter because interest rates were at zero, so anything that pays a dividend should be worth more. Well, that was true 2 years ago. Stuff continued higher, but now I don't know. These stocks that I don't think stocks are worth what you see them trading at today if they're going to go lower over the next couple months for the most part.
Well, when they said valuations didn't matter, I shook my head. That's like saying it doesn't matter if the armor on a tank is made out of toothpicks. It looks terrific.
Yeah, well, the best argument I heard people make for that statement, which is a true argument, is that valuations do not matter in a space of 12 months. They don't really forecast or really have any predictive value for what the market will do over the next 12 months. So, in 1999 in January, the stock market still went up for another year, and same thing in 2013. But they do matter in the long run if you're going to invest for more than a 12-month time horizon, which is actually what most regular individual investors are doing. They're not trying to trade in and out of the stock market necessarily. But the problem is they do matter in the end, and that's what we're seeing. It's one of the big problems of the stock market is stock prices are high, despite, what the news is about, bad news or good news. It almost doesn't matter anymore. But when you have a bear market, one of the big factors is a huge increase in volatility. So you do get these big swings up and down. I mean, when is the last time we've seen the Dow go up 1,000 points in 3 days? Well, or make a move of 1,000 points in 3 days. You've got to go basically back to August when we had that big dump that culminated with a 500 point, almost 1,000 point, gap down morning, and we came off a high and just went straight down and then recovered and basically went nowhere and couldn't make an all-time high again. But those moves provided a lot of excitement for people, manic swings. The big drop in August caused some to sell out and panic, and then others to try to chase it when it rallied back up. And, look where we are now. Months later, we're just, basically on those August lows. So that's something that happens in a bear market. You see all these giant moves, but in the end, they're not actually leading you anywhere. So right now, the Dow went up 1,000 points in 3 days, but in 6 weeks, it could be right back on the low or right where we are now. It's just kind of a market that causes most people who try to trade it to basically chase, get attracted to these big moves and buy into peaks and then lose money. One of the things I follow is Ameritrade releases once a month report of what were the most actively traded stocks in the month before. And interestingly enough, the CEO of Ameritrade last summer in June and July, he gave several interviews on CNBC and some of these financial shows saying that the people that have Ameritrade accounts, they're monitoring, several million of them, that they were all fully invested, some people on margin, and they're saying they basically have no more money to buy more stocks with, no cash reserves. And he was warning that that was a sign of a top. Well, now we see he was correct, but what's interesting is in January, when it came to the Ameritrade people, they were actually net buyers of stock and not net sellers. So they were going on margin or, using money that they put in at the start of the year to do more buying. And so the little guy hasn't been selling out of the market. And interestingly, too, the top traded stocks in January were Facebook and Netflix and Amazon, the same basically half a dozen fad stocks that were super hot in 2014. And these stocks actually did have short-term pops on their earnings dates, and the Ameritrade report said that that's what attracted people into buying them. Every single one of them, though, is lower now than they were in January. So once again, people caught, they see the news, they see a big up day, ignore the bigger trend in the market just because of the excitement of the moment, and get tricked and trapped into these sucker rallies. Now, money can be made by betting against these junk stocks, or the worst of the stocks that are just falling. I'm not short or betting against that Jack in the Box, but that's an example. But there is money to be made buying. It's just few people are doing it. And the place, I think, to make money buying is gold, silver, and the mining stocks. Year to date, they're the best performing thing in all financial markets. They're starting a new bull market. In bear markets, you want to sell the rallies and bet against stocks. In bull markets, you want to buy the dips and buy the pauses. And we had a tremendous move in gold in January and carrying over into February, and it looks like gold and the mining stocks are now starting to pause, perhaps go sideways a couple weeks, maybe even a month or 6 weeks, and that would provide a great entry point to buy. And if they pause and consolidate and break out again, say gold goes through 1280 in a couple weeks, that would just set the stage for a nice move for the rest of the year. It could go on 3 to 5 years. It's the start of a new bull market. So just as the stock market this year has tipped over, gold has come alive. And that's something I think everyone can be excited about. Not only a few people really like to bet against stocks, but everyone does like to buy. You just got to buy the right stuff. And this is something finally, after years, it's come alive. I
was going to say then, for Facebook, Amazon, Netflix, Google, things for the memories?
Yeah, I say so. And now look at Barrick and Newmont. And the thing about the mining stocks is what's one of the things that's been happening, and this is typical of a mining stock when they go into a bull market, when the sector goes into a bull market. The stocks that go up the first tend to be the big cap stocks. And the reason why is when you have an end of a bear market, people are worried, or they get worried that some companies may go bankrupt, or they see the low prices in gold. This is what's going to happen to the oil market too, eventually. But they see the low prices in this, whatever the commodity is, and they think, well, a lot of these companies could go bust. They got big debt loads. They're not making much money. This is very risky. But some of the large companies don't have those problems. They're profitable already. They have cash reserves, or they've pared back their debts over the past couple of years. So that's what tends to happen is these stocks lead first, and Newmont and Barrick have gone up tremendously over the past couple of weeks. And then as time goes on, and this can take a couple months, to really play out, money will go into the more speculative names. And this is even more pronounced today because so much of the trading and the investing and the buying in the financial markets is being done through exchange-traded funds, which tend to own these big cap stocks and ignore the smaller, more speculative names. The junior mining space is not in the GDX ETF, and only a few of them are in the GDXJ ETF. Now, what will happen though is eventually people are going to see Newmont and Barrick go up enough, or these exchange traded funds. They're going to ask themselves, well, some of these juniors haven't gone up yet. There's good value there, and they're going to pounce on them too. That hasn't really. They've moved up, but they haven't gone up like the big caps have. But that'll be something to watch for later in the year. So, about someone may think, well, Newmont and Barrick has just gone up so much, I can't buy those stocks. But there's a lot. This is a pretty big sector, and the funny thing is, if you go on stockcharts.com, the GDX ETF, there's this other ETF, DUST, which is a short ETF for the mining stocks, which is at this point a suicide ETF to buy, but people are trading it. But these ETFs are always coming up as the most popular typed in symbols that people are looking up. They do among the top volume in the financial markets. If you rank all the ETFs by volume, they almost always come in the top 10. On Friday, GDX was the third most traded exchange-traded fund. So that means a lot of people are trading these things. These people probably haven't been around as long as you and me have in these financial markets, or at least in the gold market, and I doubt they know much of anything about the junior mining space. But at some point, these people or other people are going to want to get into that. So I think that's really the investment opportunity right now. I mean, I know, been warning about the stock market and telling people to be selling, but I think today we can really tell people, don't just sell to save money, but sell to put your money into something that'll make a return.
We'll have more with Mike Swanson right after the break.
Unbelievable harmony, spectacular performance, the ultimate tribute to the Everly Brothers and Simon & Garfunkel. Bird Dog and the Vintage Electric Band coming to Fort Langley, Mission, White Rock, West Vancouver. Buy online and save at ontourtickets.com.
Welcome back. We're speaking with Mike Swanson. Is there any hope for the people who are looking at crude to make a move this year?
Well, I don't see it anytime soon. We did have a nice another nice little bounce, I guess you can call it, in crude. It's quite amazing. You think where it was a couple years ago. And I went to the gas station last week and filled my gas tank up for $19.96. And the last time I did that was probably 1999 or 2000. But it's still in a bear market. And the thing about oil prices is in 2014, we saw the largest ever, it was a historic thing that happened, short position in the commercial market, the commercial futures market. These are large operators, companies, producers, even nations, or sovereign wealth funds like you see in Saudi Arabia. They took a gigantic historic short position in the oil market before oil turned down, before the oil stocks turned down, before I was thinking about oil at all. And that kicked off the bear market. And they've only covered about half that position. That doesn't mean it's going to fall for another year, but I think it means we have another year before they're done with their short position and it starts to go up. What tends to happen with commodities is when commodities are ready to start a bull market, this commercial short position either becomes extremely low, which actually is what happened with gold starting in July up to now. The short position became the lowest it had been since about 2000. And actually a lot of commodities are in that position right now. A lot of the agriculture commodities have very low commercial short positions or even that long, but not yet in the oil market. So I think we've got a lot of time or the rest of this year. And I think, I don't know where it'll bottom out. I'm not thinking it's going to crash or something, but it can simply go sideways for the rest of the year. That's kind of what gold did. Gold really went sideways for about 2 years when it would break 1100. That was one scary level everyone was looking at in 2014. It didn't really fall anywhere. It went down to about 1050. There are so many predictions for 900 gold, 800 gold, and none of them came true. And that's really what we should eventually see people do with oil. We should start to hear predictions of oil going to $15 or $18 or something somewhere below 20. And we really haven't heard too much talk like that. I just think it's more of a time factor that needs to play out, and I'm really interested in eventually investing in oil stocks. They do, pay dividends, and they are great investments when the cycle's right, but the oil stocks are probably going to lag even the price of oil. Even if oil has bottomed and is going to simply go sideways, the oil stocks can simply continue lower because a lot of them haven't cut their dividends. They haven't accepted the reality of these low oil prices, and the stocks still have high valuations from a historical standpoint. So it could even if oil bottoms this year, it could still end up taking another year or two for the oil stocks to put in an end to their bear market. If you go back actually to the last, if you forget about the 2008 thing, but if you go back to the actually longer bear market for oil was in the 90s, there was a major low put in the first quarter of 1999, but the oil stocks didn't really go up until 2003 when the Iraq War started. So I think we're really a long ways off for the oil stocks.
Mike, thanks a lot for chatting with us.
Thank you. It's great to talk with you as always.
My guest has been Mike Swanson from WallStreetWindow.com. You're listening to HowStreet.com radio. Find us on Twitter at Talk Digital Net. Our YouTube channel is Talk Digital Network. Comments about the show can be sent to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.